Hi everyone, in this video we'll talk about market breadth, how to monitor it, how to evaluate market health, and how to gauge sentiment of the markets by just looking at some numbers. Now, market breadth is a critical component to analyze in the markets. Basically, it is just observing the market in such a way that it gives an indication of where it stands. Example, let's say in the in all the stocks available on National Stock Exchange, NSE Nifty, 50% of stocks are below 200 DMA or 200-day moving average. Now that indicates a bearish sentiment. You can also say that when 90% of the stocks are above 200-day moving average, that indicates an overly positive sentiment, and we need to be a bit cautious. So, what are these key metrics that we look at to gauge market health, market breadth, and what insights can we draw from it after looking at it day by day, week by week, or month by month? Understand that market is trying to tell us a story that we as participants should hear whatever the market is speaking about. And market doesn't have its own voice; it speaks us through numbers, right? Markets go ups and downs just like our emotions. Sentiments weigh heavy on the markets, and irrationality is all over the place some days. Once we start treating markets like humans, we start to accept its volatility even more. Now, market breadth is such tool which gives voice to the markets, and if we are patient enough to listen, we will get a really good grip of what the market is feeling and trying to tell us. Once we know what the market is trying to tell us, we can then think how we can take decisions and move ahead with that information. All it takes is practice over time to get good at hearing the story that the market is telling us, and that's what we are trying to do using this Google sheet. And the bedrock of this Google sheet will be Google Finance, just like the other videos. I'll share the link for the relative strength video in my description if you are interested in more such content. Now, let's start with the introduction. What is market breadth? Market breadth is a metric used to evaluate market health by analyzing the number of stocks participating in movement. That's it. Nothing more, nothing special. Instead of focusing only on Nifty 50 or Sensex 30, market breadth provides insights into strength or weakness of a broader market, right? So when we say a broader market, I'll actually zoom in a bit so that you can read it a bit better, right? Broader market means we don't only focus on top 50 or top 30 stocks. We look at a bit broader market, like we also look at mid caps, small caps, and even micro caps to that extent. So, for the purpose of this video and the tracker that we'll build, we will only be considering top 750 stocks on the National Stock Exchange. Now, question two, why is the market breadth important to keep track of? As said in the introduction, it helps us understand the markets better and develops a gut feel, which is important for every investor and even a trader. Breadth helps us in the following ways. These are just three examples. There are more ways it helps us, which you'll eventually figure out once you keep tracking it day by day. So, one of the ways it helps us is in confirmation of trends. Widespread participation in a rally confirms a robust and sustainable trend. Now, what do we mean by that? Let's say Nifty 50 went up 1% in a day, right? Nifty 50 has large caps only. It doesn't show any mid caps, small caps, or micro caps participation. Now, if a flagship index of a country is going up, right, is it only the large caps that are gaining in momentum, or small caps, micro caps, and mid caps are also participating in the rally? What's happening in the entire spectrum of stocks, not just the large caps? This is what we get through market breadth. So if the rally is happening in mid caps as well, small caps as well, micro caps as well, and in large caps, that means overall market sentiment is good and it should keep on going ahead in a momentum basis. So we can get more confidence by seeing these metrics. On the contrary, it also gives us some reversal warnings. Divergence between index performance and breadth metrics can indicate potential reversal. Let's say large caps are moving higher, but your small caps and micro caps and even mid caps are taking a hit. right? That means the sentiment right now is only good for large caps and not so good for small caps and micro caps. That generally shows a divergence, right? And we generally become a bit cautious at that point in time because we want the full market to participate in the rally. That gives us good odds of selecting a good potential investment opportunity and sticking with it in the momentum phase, right? So reversal warnings are something that with time you'll identify, but in the initial phase of you using the market breadth, I think confirmation of trends would be very, very easy to spot. Now, this third example that I have, I just spoke that in the introduction as well. It's health check for bull and bear markets. A very basic example is 50% of stocks being above 200-day moving average. So you can think of 200-day moving average as um, the long term average, right? Where the stock should move. So if something is below the 200-day moving average, that means it's potentially bearish, right? And you should not put your bet into it, I would say. But here we are not talking about one investment opportunity or five investment opportunities. Here we are talking about 750 stocks. Let's say 375 out of the 750 stocks are below 200-day moving average. Now that's some bad news, right? You cannot, be in an environment where where it's a bearish sentiment. So this is the health check metric for bull and bear markets. If 50% of stocks are below 200-day moving average, it indicates a bearish sentiment. Now, please don't quote me on this. This is just what I have been seeing in the markets. If you feel this number should be 40% or 60%, take your call. Do what your gut tells you. There is no hard and fast rule here. It's just that this cutoff. I have seen many people tweet about it and talk about it in multiple forums. Building upon the three examples that I shared of how I use market breadth, there are a few more examples that I have noticed in the past 1.5 years that I would like to share before we begin the Google Sheet exploration. If Nifty 50 rises by X percent, but only 100 out of 500 stocks in an index are advancing, it suggests that a small group of stocks are driving the gains. I'm sorry, I said Nifty 50, it should be Nifty 500, right? On the contrary, if 400 stocks are advancing, that means there's a broad based participation, not just 100 stocks. Just to give you a background, Nifty 500 comprises of Nifty 50, Nifty Next 50, Nifty Mid Cap 150, and Nifty Small Cap 250. If you sum it up, it becomes 500. So when you see Nifty 500 in action, it's actually a broad based index. So it's actually a better index to track than Nifty 50 if you want to see broad based market participation. Next example, when Nifty 50 is rising by X percent, but overall 750 stock universe is not participating in the rally. This is exactly what we talked about in reversal warnings. This shows divergence between large cap versus mid cap, small cap, and micro cap. And you don't need to be a rocket scientist or a data scientist to see it. All it takes is just basic market breadth knowledge. When stocks above 200-day moving average breach 90%, that means uh, 90% of 750, which will be, I think, just above 670, right? When those amount of stocks are above 200-day moving average, then the market is probably very much overheated and one should be cautious while taking positions, right? Just think about it. If 90% of stocks are outperforming long term averages, this is an extremely rare event. And it cannot happen, right? How can 90% of stocks be much better than the average? If everybody is extraordinary, then who is ordinary, right? So markets are just like a classroom. There are only a handful of students who outperform again and again and again. 90% of a classroom cannot be an outperformer, right? So that's the rule that market bread takes in. It's a collection of the masses, it's what the herd tells us, and that drives the sentiment. Now, the introduction is in the clear. I'll zoom out a bit and we'll discuss the key metrics. The key metrics that we'll track are from row number 7 to row number 19. I'll zoom in a bit again so that you can read it clearly. Number of stocks up 3% in a day. We are sticking with the 750 universe. To give you a breakdown of 750 universe, it's Nifty 500 plus Nifty microcap 250, right? Uh, we do have to keep checking that the list keeps updated. So every month I do a check on these links of NSE India, and if the list changes, I change that in my tool as well. And you can do the same. So stocks up 3%, stocks down 3%. 5-day ratio, 10-day ratio, I'll come back to it a bit later. So stocks up 3% in a day, stocks down 3% in a day, right? Stocks up 25% in a quarter. That means the last 3 months. Stocks down 25% in a quarter. That means last 3 months. Stocks up 25% in a month. That means 1 month. And then 13% up and down in a month. So just see how clever this is. We used today, which is the shortest time frame. Then we used a quarter, which is a large time frame. Then we used a month, which is an intermediate time frame. And then at the last, we have percentage stocks above 21 DMA, which is a short term average, stocks above 50 DMA, which is an intermediate term average, and then stocks above 200 DMA, which is a long term average. So we cover all parts of the game: short, long, and intermediate. Now, coming to 5-day ratio. When we work with stocks up 3% today and stocks 3% down today, that's a bit tough to understand, right? Because it's a very short time frame to gauge market sentiment. Let's say today 100 stocks were up more than 3%. Tomorrow, only five stocks were up 3%. Will you say that one day the sentiment was positive and the next day the sentiment was negative? Ideally, you cannot, right? So, to cut through the volatility of daily movements in market breadth, we introduced a 5-day ratio and a 10-day ratio. This 5-day ratio talks about the last 5 days in numerator where the stocks were up and the last 5 days in the denominator where the stocks are down. I'll quickly show you this number here. So if you see here, this calculation, it's sum of last 5 days divided by the sum of the down 5 days. So number of stocks up in the last 5 days, number of stocks down in the last 5 days. Similarly, we have a 10-day ratio. Last 10 days, last 10 days. And this ratio is an oscillator ratio. This oscillates between certain numbers. If you see, I've seen it go to 4, 6, 7, right? And then it goes down to 0 as well. And you can color code that. So coming back, stocks up 3% in a day. Today, up 3%, down 3%. Up 25% in a quarter, down 25% in a quarter. 25% up in a month, down in a month. 13% up in a month, 13% down in a month. And then 21 DMA for short term averages, 50 DMA for intermediate term averages, and 200 DMA for long term averages. Okay, now we go to the sheet. Now, this sheet will be extremely similar to what we created in the relative strength video. If you haven't seen that video, I'll add the link in the description and even in the top right part of your screen. So I highly recommend you watch that, as many of the concepts I will probably skip, but I'll try to explain it to you how I'm getting the values here. So column C, D, E, F, and G are just copy paste from these links of Nifty 500 and Nifty Microcap 250. You get a CSV file, you can download it, and you can paste it in column C, D, E, and F. And there are two indexes, Nifty 500 and Nifty Microcap 250. If I remove Nifty 500, you can see Nifty Microcap 250 being pulled in here. So that is pretty easy. Next, we create a column H where we create a ticker. So in Google Finance, you cannot just write give me stock code for AGI, right? You have to give it a particular ticker. Ticker is for any Indian stocks. We have to put NSE colon and then the ticker name. So for 360 ONE 361, we put NSE colon 361, and then we use the Google Finance function. I'll zoom in here so that you can pause the video and check how I use the Google Finance function. There's nothing. I use the Google Finance. I enter the ticker, which is H4. I want the price. I want the date 31st December, starting date 31st December, ending date, because that's the date I want. I don't want before that or I don't want after that. And I want it on a daily time frame. If I just copy this formula and show it to you how it works here, so L21 is equal to, so I get a 2 by 2 grid where I get date, close, and the price 1254.8, right? Now I'm only interested in this cell 124.8. So what I do is I enclose this array or this data into an index function. I say give me row 2, column 2. This cell is 2 comma 2, right? Second row, second column. And that gives me the value 1254.8. So I wrap it in an index function. I give it row number 2, column number 2, and I get that cell value in that price. And I repeat it for 750 stocks. If I can get price for one day, I can divide it with some other day and get return values, right? Exactly same concept. I divide the price that I find in I4. I get the value just by using the index function, right? And I get one day of return. Can I, and if I can divide it by one day of return, I can get 1 month return as well. I just need to change the values. If I can get 1 month return, I can also get 3 month return, right? That's the beauty of this function. If you know how to calculate price or get price for one day, you can convert it into 1 day, 1 month, or a 3 month, right? So this one day, I'll actually show it to you. So I'll actually copy this sort completely and is equal to, so if you see, I'm getting this 1254.8 and on 30th December it was 1270.5. So I have to divide 1254.8 by 1270.95, which is row 1, 2, 3 and column 2. So what does my function show? Index row 3, column 2. And then I compute the return values. See, simple. At the end of it, it's just basic division. The formula seems a bit larger, but the concepts are still the same. Similarly, for 1 month, I change the numbers. I do a minus 30 so that I get 1 month before value. My sorting here is a bit different because I would like the first value. So I'll copy paste it and show it to you again. How does this sorting work? So I copy till true, copy, I2N is equal to paste. So if you see, I sorted it based on the date. I wanted 1144.6. And now I want row number 1, column number 2. Row number 1, column number 2. Right? And now I'm dividing 1254.8 divided by 114.6. Now, of course, you might say that this is not the perfect, accurate 1 month return. Yes, I agree. We are not trying to, be extremely accurate with this. Uh, we just want to make sure that we are taking cutoffs in a reasonable manner. If it's 1 2 days up and down, it's completely fine. That won't hurt the breadth analysis much, since this is an amalgamation of 750 stocks, not just one stock, right? Now for 3 month return, exactly same concept, and we did the same, right? Okay, so 1 day return, 1 month return, 3 month return, perfectly done. Why have we done this? If you notice, I want daily return in row number 7 and 8. My row number 9 and 10 are dependent on the daily returns in row number 7 and 8. Row number 11 and 12 are in a quarter. Quarter means 3 months. So I'll get the values of row number 11 and 12 from the 3 month returns. Row number 13, 14, 15, and 16, I'll get it from the monthly returns. And now the only things left are 17, 18, and 19, which are short term, medium term, and long term averages. So I go to the universe, column M. Okay, so what are we doing here? I want 21. So I use the same sort function. You should be pretty clear about right now what the sort function in Google Finance is doing. Then I wrap it in a query function because I only want the top 21, last 21 days performance. So this is an SQL query which I can run on this, right? And then I wrap these 21 numbers into an average function and I get the basic average price of last 21 days. And if I have the 21-day average price, I can calculate if my current market price is greater than or lower than the market price. Oh, sorry, my current market price is greater or lower than the average price. And this is a flag of above or lower, right? So we can see this 360 ONE script is above its 21-day moving average. And if you would like to see it on the charts as well, 361, it is above its 21-day moving average, right? I'll go back. Same for 50-day moving average. Query, select column to limit 50 and wrap it in an average function. Now, is it above or lower this 50-day moving average? Yes, it is. And we can confirm it on the chart. This yellow line is 50-day moving average. It is above that. Similarly, for 200-day moving average, select column to limit 200. That's it. And then same flag again. I haven't really done anything complicated up until now. It's just basic formulas and replicated across time, right? 21 days, it's a time. 50 days, it's a time. 1 day, 1 month, 3 month. I am just playing with time here, nothing else, right? Now that this 76750 stock universe raw sheet is made, now we'll start calculating the market breadth on a daily time frame. I'll request that you don't look at the output below. I'll just clear out the screen a bit and I'll zoom in. So think of this like, okay, so now I want for a particular date number of stocks up 3%. So this date I link with my sheet 750 stock universe, whatever date I have here, right? I3. So my here I'll get I2 because I2 has the date, right? And I'll come back. Okay, whatever data I input there, I'll get it here. Now, count ifs in column J greater than equal to 0.03. Now, what is column J? 1 day return. If it's greater than 0.03, it made more than 3% return, right? Greater than equal to, apologies. Similarly, less than equal to minus 0.03, I'll get the count, right? Now moving to the quarter ones, just the column will change. Column L. What's column L? 3 month return. And what's the cutoff? 0.25 minus 0.25. Exactly same calculation. Let's do number of stocks up 25% in a month. Column K. What's column K? Oh, it's 1 month return. And we go back. 0.25 minus 0.25. Now the 0.25 and minus 0.25 will become 0.13 and minus 0.13. The column remains the same. And then for the last three metrics, column N. What's column N? This flag above or lower. What are we doing here? We are counting one, how many ones are there, and dividing it by 750 because it's a 750 universe. Number of ones divided by 750. So 25.5% of the 750 universe stocks are right now above their 21-day moving average. And 38.4% stocks are above 50-day moving average. Similarly, 45.2% stocks are above 200-day moving average. Column names just keep changing. N becomes P and then becomes R, right? And then at the last, we just calculate Nifty index. So to calculate Nifty 50 index value from Google Finance, we used index NSE rather than NSE only. So we get price, date remains the same, start date, end date exactly the same. We want the daily time frame, and in the index loop, we put second row, second column, just as explained earlier. So this gives us what we want to see. This exactly gives us the market breadth of a particular day. So now I'll remove the rows that I hid from you earlier, and I'll explain it to you why these make a lot of sense. Now you're not just looking at the breadth analysis for one day. Now you have it for each day for the past 1.5 years. And now you can see market through its phases, when it goes up, when it goes down, what's the index performance, when were stocks above X percentage in an average scenario, or when markets were overheated, when they are in a bearish scenario. You can do that relative performance by analyzing it day by day. And just as I showed you this 5-day ratio and 10-day ratio, you cannot calculate that on a daily basis. You can only calculate 5-day or 10-day ratio when you have past data available, right? Full disclaimer, this is only for 750 stock universe, not beyond that. I, as an investor and a trader, believe that going beyond 750 stocks in NSE has extremely low liquidity. And for a new and budding investor, and with less than 10 years of experience, we should only dabble in the most liquid stocks available. And it helps us learn a lot more about price and volume behaviors. Having said that, this grid is a game changer for learning how the markets behave. I have been tracking it for the last 1.5 years almost now. And post doing that, I saw real value in it, and I wanted to make some content on it for to share with everyone else. Now, coming back to how to understand it. If you remember, I earlier told you that if percentage stocks above 200-day moving average are less than 50%, it indicates a bearish market scenario. Just look at the performance post that. It's really choppy, right? In the middle, when we went above 50%, so 26th November, we had less than 50% stocks. Post that, when we moved above 50%, we got a lush of green returns, right? So this kind of tells me that there are periods when market is safe to get in, and there are periods when market is not safe to get in, right? So what are those cutoffs? Those cutoffs may vary on your gut feel, on your experiences. Based on my experiences, I'll immediately show you what's the conditional formatting that I use. And I can zoom in on this right hand side here. So this is for column C, number of stocks up 3% in a day. If it is less than or equal to 35, I keep it a red. That means it's bearish. If it is greater than or equal to more than 200, I believe it's really strong, right? So I keep it a dark green. If it is between 75 and 200, I keep it a moderate green. Between 35 and 75, I keep it a white. That means it's inconclusive and I would not like to read much into it. Now, when I go to column D, similar vibe is just that I shifted the scales a bit. So now that 75 became 50 for red. Greater than equal to 200 is extreme red, because this column is number of stocks down 3%, right? And we can see this 20th December was an extreme action day, right? We immediately dropped from 53% stocks above 200-day moving average to 47.3% stocks below, right? And that day, index dropped 1.5%. And even see this 5-day action. 60% stocks were above 200-day moving average. And these 5 days, we got hit pretty hard, right? And what were the dates during these 5 days? 16th to 20th December. Let's check the Nifty chart for 16th to 20th December. So this is 16th to 20th December. One second. 16th to 20th December. These 4 days, right? 16th, 17th, 18th, 19th, 20th. Look at the fall and look at the, price action that happened that day, right? So if you see this and then you see this, oh, like, oh, okay, something is up here, right? You would like to stay away from the markets if this sort of volatility is coming in. And exactly what I did post that. I saw, okay, post this, I haven't been, in the markets very active because the ratios are really negative. I don't want to get into that right now. Whereas before 12th December, it was decent. Between 27th to till when it is? Till 60 or 53, in fact, till 19th, it was still fine, even though from 16th we started falling, right? So I can see that this is that period. This was fine. The market was moving sideways, and in fact, 21-day moving average and 50-day moving average moved upwards, right? So this was something positive. So you can make your own cutoffs and play around with it. For 5-day ratio, what do I do? If it is less than or equal to 0.75, I keep it a red. Greater than 2, I keep it a green. And all the others are inconclusive as per me. You can change your cutoffs if you like it. Now, for 10-day ratio, I keep it the same. Just notice why it is 5 and 10. 5-day represents 1 week of trading activity, 10-day represents 2 weeks of trading activity. Of course, 5-day will be more volatile. It will give me an early signal of improving conditions or deteriorating conditions. 10-day will give me a with a bit of a lag because it's including the past 10 days, 2 weeks of trading action. So that's why you see when 5-day becomes a bit cautious on 13th December, I can immediately say, oh, okay, something's up. But the 10-day took its while to become cautious and then move into the bearish territory. So you can start reading these variables like a participant in the markets and an investor, and you'll start to understand that there are multiple storylines that the market is trying to tell us. And the more you think about it, the more prettier this analysis gets. Now, moving to column G, 100, 50. If it's greater than 100, we keep it green. Less than 50, we keep it a red. If you notice, in the recent month since October, we are only getting reds or whites. But before that, in still September, look at the numbers. Greens all over. 200 stocks are above 25% in a quarter. This is optimism, right? So back testing and back data analysis gives you a lot to learn from the markets. And if you see in that time, the index was flourishing. August, July, and June, we're all going up. And even in April, right, we can see the signs. There is nothing red in the past 4 5 months. Now we are facing some reds. So that means the market environment has deteriorated. We are not at that health right now. Maybe we are in a period of consolidation, right? Now for column SH, it's 35 and 18. Maybe this is the bias right now that I have because since I started tracking the markets using this tool, the market has just been on an upwards trajectory, right? So these cutoffs will probably change with time, but I just wanted to show you the cutoffs and I'll, stop wasting much time around it. For number of stocks, 25% in a month, the cutoff is 18 and 35, similar to column H. Column J is also again 10 and 5 right now, but I don't use much to read into it because this I feel is not that much of a helper in understanding market environment, but certainly a good number to track that how many stocks are down more than 25% in a month. Now 13% is where the game gets interesting. This is where I see a trend picking up. Whenever 13% cutoff, which is approximately half of 25%, I when these numbers rise, right, it gives me a decent inclination that okay, something good is happening. But when this number falls below 50, I'm like, okay, the steam is out, right? Money is not flowing in much. And similarly, when number of stocks 13% down in a month increase immediately, it's a caution. If you see when the trend was really really good in the Septembers and the Julys and October, this number never went beyond 30 or 40, right? This just was green all over. Yes, there were periods where, we struggled, but it never went below that. So, based on that, the cutoffs here are 35 and 75, but this is a good metric to keep a track of. And now we reach the main metrics 21, 50, and 200. This gives me a time scenario. short term, medium term, and long term. In short term, what's happening, medium term, what's happening, and long term, what's happening. So in long term, you see, if the value is greater than 90%, I make it an extreme red. For me, that's an overheated signal, right? And this less than 50% is a bearish signal. That means I need to stay away from the markets, right? It's not a good time to at least take a position right now. For medium term, I have seen that cutoff to be 30%. And for short term, I have seen that cutoff to be 20%. And I'll show you in the historical data how it plays out. So if you see, whenever we go below 20% in short time frame of 21 DMA, we get a bounce back. And I've seen this multiple times happening in the past few months, right? It happened this time around. What's the date? This is 29th October. Post that, just look at the bounces we got, and post that Nifty 50 performance improved, right? Of course, then we went down again, and then we got a bounce again. So this might just give you an oscillatory behavior, because these are extreme numbers. As I said, markets act like a classroom, right? You cannot have 10% of people above their short term averages. Of course, it has to rebound. You just don't know how it will rebound. Similarly, if you see here, 7th October, it immediately, we went down a lot. And then next day, we were back. For 50 DMA, for 50 DMA, you see that cutoff goes very well with 30%. So as less time as a variable spends, under a certain cutoff, it helps a lot. And now I'll show you that 90% cutoff and how it worked really well for me. So this, you see, this January, we saw 90% stocks above 200 DMA. And look what happened after that. 0.91% decline, 2 or 2.5% decline. Of course, it's a choppy behavior. I'm not saying that the index won't gain value from it. So it was 21,710. It's still 21,737. Index hasn't lost much value, but the breadth has gone from 90% to 85%. So you can actually see that market is overheated and these numbers cannot sustain for long, right? And this is how one can probably read into it, okay, what's going on. So let's look at this. On 19 December 2023, 90% of the stocks were above 200 DMA. The very next day we had a sharp fall. I'm not saying this is a good predictor of the markets, it very well may be, but as of now, just start reading this. Just start seeing day by day action, week by week action, month on month action. You will start to learn a lot, and maybe even you come up with a good predictor model that helps you tell what's the decision, whether the market is overall positive or overall negative. Now this was the daily behavior. Now let's go to the monthly behavior. I keep pasting every end of previous month data here, right? This helps me time my SIPs and lump sums. Now, how do I do that? Very basic. You count the same columns, right? And since it's above and 50 lower DMA, I'm just doing a count ifs again. And I'm dividing it with the index that I have. So for Nifty 500, what percentage of stocks are lower 200 DMA? It's 56%. Lower 50 DMA, it's 63%. Similarly for microcap 250s. What are the numbers? I'll zoom in if you want to see this formula, but it's the exact same formula as I explained it to you. So here, here, and here. Now, what value does this add? I get to understand when one should go the SIP route. So, for example, from May of 2023 till October, I I did SIPs in Nifty 500. In November, I did some lump sum allocation because I saw the index correcting a lot, more than expected, right? Similarly, I did some lump sum investments in 2024 April. And now I have been going lump sum for the past 3 months. And since we are in January right now, these numbers are end of December. And whatever numbers we are getting right now will update as per January number. So that by the time January ends, I'll know what I have to do on February the 1st. You notice whenever you buy when index are beaten down, or stocks are well below their averages, you get good value out of it. The only thing you need to remember this strategy only and only works if you believe in the India story, right? This takes into assumptions that indexes are a good long term bet and it will go up eventually, which strategy is, I think, a fallacy in the first place. But you may or may not agree with me. That's just my humble opinion. Again, this is all for an educational purpose. I am not recommending any SIPs or lump sums from my end. If you would like to follow these numbers with me, I have a newsletter that I share out every Saturday of every week showing these numbers and the daily market rates as well. I would be more than happy to give you these numbers from an educational perspective, and I'll share that link in the description for you to sign up, and it's completely free of cost. So don't worry, nothing is chargeable, it's free of cost. And the intent here is to make everybody understand what the markets are, how do they work, how to read the markets, and how to prepare for the upcoming weeks or upcoming months, right? If you like this, please like, share, and subscribe. I'll be posting more content, more such content in the future. And yeah, I'll see you in the next one. Thank you for watching. Disclaimer: this content is for educational purposes only. None of the brands, products, tools, or stocks mentioned are recommendations or endorsements. The creator is not a licensed financial advisor. Viewers should conduct their own research and consult with a qualified professional before making any financial decisions.